Hey everybody, it's your buddy Dow Jones Dave here, and I just got my first look at the yield curve, current yield curve, for the first time in, I don't know, I haven't looked at it in a long time, let's put it that way. But I used to watch it pretty carefully. Our current yield curve is in the blue. And when I first pulled up this chart, well, it's a good thing I'm kind of inebriated because I might have had a heart attack because I've never seen anything even remotely like this, not in 30 years of watching the market. And I've seen enough yield curves to know that this is unique. I've never seen anything like that blue line. Well, first, let's look at it. What's a normal yield? What is a yield curve? We're going to put this in the Dow Jones Dave investment class playlist here. A yield curve is the stream from short-term to long-term bonds. This is 1 month out to 30 years. A healthy yield curve, or normal yield curve, starts with a low interest rate and the low time frame. 1 month, you can borrow 1 month for pretty cheap. Then it'll move up pretty steeply through 2 months, 3 months, 4 months. And then once you get out to here, it'll level out a little bit, but still rise, and the rise gets shallower, but it continues to rise all the way to the end of the yield curve, which would be the 30-year Treasury bond. Now, I personally, as you noticed, watch the 30-year Treasury because I know the market likes the 10-year, but the 30-year is the one you want to watch to compare your yields to Dow dividend yields. Okay? The reason is people generally buy Dow industrial stocks, and I cover Dow industrial stocks in the composite, so is for the yield and the fact that the Dow industrial stocks regularly raise their dividends. You can pretty much count on it. So by sometimes a pretty good amount, like a couple of companies just boosted 10% just this last few weeks. So, people are looking at that, and they're looking at 30-year treasuries because, a Dow stock is something typically people buy and hold, like to put their kids through college or whatever. I don't know if anybody actually does that. I've never had kids or been married, thank God. And so I don't know. I don't know if anybody actually does buy stock and just put it away for 30 years or in a Roth IRA for 20 years or whatever. But in that case, you're a long-term investor on this scale, 20 to 30 years. And I would use 30 years. I do watch the 30 year. And because I only watched the 30 year, I had no idea this yield curve looked like this. This is insane. Here's a healthy yield curve. A normal inversion looks kind of like this. Somewhere around here it goes, and then it'll move up. Like somebody stepped on it and dented it, That's a normal, that would the shape of a normal inversion. Okay? This is, when I first saw it, I actually thought in my brain, oh my God, like in a Valley Girl accent, oh my God, because this is nuts. So here's the question. What does this imply? I'm not sure, except for I know it's really not, except for I really know it's unhealthy. It's not good. It's damaging to the underlying workings of the economy and the markets. And I'm actually surprised the markets went up a penny looking at this thing. So the big question is, so now we know what a healthy yield curve looks like, what a normal inversion looks like, and what we've got today, which is horrendous. This is just, the reason is so horrendous. It's not horrendous. You just got to understand what it's going to do. And what it's going to do is either these are going to come down and under these, or these are going to go up over these, but probably a combination of both. And since the market concentrates on the longer term bonds, you can see what I'm saying here, that when these things uninvert, it's going to be pretty brutal. You see what I mean? So like I said, I don't know all the implications of the yield curve. Supposedly they have something to do with recessions and all that, but I actually look at other stuff, other items now, for information on that as opposed to the yield curve. But the yield curve, I'm actually glad I pulled up the chart, because I thought, all right, everybody's all upset about a yield curve and inversion, and I expected a normal inversion like the one in red there. And so when I pulled up this chart, I'm like, holy moly, what am I looking at? What? So I have no idea what all this means, except for it's a no-brainer that 30-year and 10-year are going up. All these bonds that are under this center line are going to rise. And these will probably come down at some point, but I don't know. You see, I don't know which way it's going to go, but I know that bonds are looking really bullish right now, so I think we're going to start correcting this inversion on the long-term end. The short end, don't know what's going to happen. I could see the short end coming down and the long end going up, and that'd be pretty negative for the stock market, because like I said, the stock market concentrates on the longer-term end of the curve. So anyway, that's what a yield curve is supposed to look like. That's what a normal inversion looks like. And this is what we have now. I mean, it looks like somebody took a sledgehammer to it and then stomped on the end and on the 30-year with some steel-toed boots just for the heck of it. It's a lot more than what... this is, I think of it as just somebody stepping on the yield curve, right? This is just somebody beat it down with a heavy fucking object. So anyway, that's what I have to say on the yield curve, that I'm willing to bet that we're going to see some huge rallies in yields and declines in bonds, which might create a nice buying opportunity for bonds. And I don't mean bond funds, I mean the actual bond. The reason is that you got to understand these interest rates. A 30-year starts at 5%, I believe. In other words, the bond itself has a face value. I mean, yeah, it has a face value and a fixed rate payout. Let's call it $5 on the 30-year. I don't know the exact amount. But what that means is that if bonds go up above 5%, in other words, that initial face value payout, so you get a bond, it's $100, $5 payout every year, right? So that's 5% bond. So what if the bond goes to 200 in price? Then you've got a 2.5% bond. So when you see like treasuries at 2.5%, 3%, they're 50 to 30, they're like 33 to 50% discounted from their redemption value, the face value. So not only do you get that yield, that's actually counted into the maturity. So that's, I think it's counted. I believe that's counted into the yield to maturity. But if you get them when the yields are really high, you'll get a really low price. Normally, if it's 2.5, then the bond's doubled. And the good thing about that is you buy the bond way high at 2.5%. It devalues over the years and finally comes to redemption date, and you get face value, but that's only half of what you paid for. But you did get 2.5% inclusive of that capital gain, capital loss, right? Capital gains loss, I guess. In other words, your bond went from 200, it redeemed at 100, but since the yield, listed yield, say 2.5% at 100, includes that decline, you get a huge tax credit at the end of it when you get redeemed. Just something to think about, which is why you'd want to buy the actual bonds and stuff. And the reverse of that is true. If bonds are really high, then you get the bond itself at yields are high, then you get a discount on the bond. The bond will be low, and you'll have a capital gain to pay taxes on. So these are interesting things to think about if you're thinking about buying the actual bonds, which I recommend. I mean, if you're looking for 5% interest, you've got enough money to buy bonds. So let's put it that way. So as long as we're there, let's, here's this guy again. Let's take a look at treasury yield. So let's look at treasuries. It's a 1 hour chart. On a daily. By the way, I am short a number of stocks and the Standard & Poor's. I disclosed in my previous video. And the reason I'm short is because of this and the bond movement towards MACD crossover and just general technicals. This thing's blasting off. And after I looked at the yield curve, I don't think this move is excessive anymore. I used to think, well, this is excessive. It's probably going to correct, but not anymore. I think it's going to break out, and I think the markets are going to dump over the next month or so into mid-October. Seasonality is against us. The market's bonds are against us. The dollar, I know people pay attention to the dollar, but if you look at the dollar chart, oh, wait a minute, I have one right here. Look at the dollar chart, it's doubled up on the daily MACD. Look at that. Doesn't look like it's going to really slow down anytime soon. Maybe on the 4 hour. The 4 hour might come down. It might come down and retest down here. 30 cents or so. But this is that's pretty bullish, plus this is bullish. We've got a broken trend, adequately retested, perfectly retested. So this resistance, that resistance, and then we're pretty much up here. At least that's what I see. I know that's a lot for the dollar, but here's probably reasonable too. But I do see it pushing out of this trend. When they pull up, retest, and then just blast off like this, these resistance points usually don't put up much resistance. It's the upper resistance that's outside of this trend. That, like right there, that would be heavy resistance probably. If it clears that, then you're looking at this probably going up into the middle of it. See, can I get out any further? When you get up here, I don't know if it'll go up that high. I just know it's going to rally. Everything is saying it's going to rally, except for the 1 hour. It isn't too happy, so we can see a pullback formation. 5 minutes. 5 minutes is going up, so you may have already had the formation. And the bonds will pretty much look like the dollar. The shorter term, 5 minutes going to turn up. Shorter term is maybe a little overextended. We pull back to here. I don't know. A little flag box here.